Declining prices, falling transaction volumes, buyers on the sidelines, sellers with huge stocks to clear. The Singapore private property market is looking very gloomy. Private residential transactions are expected to fall 20% year-on-year, alongside a decline in property prices of around 4 to 6% by the end of this year. Since cooling measures like the Total Debt Servicing Ratio or TDSR were introduced, private property prices have been on a downward spiral. The overall private residential property index has fallen by 7.2% since its peak in the third quarter of 2013. Alongside this, transaction volumes have also been contracting. The first 2 quarters this year saw sales transactions plateauing to just over 2,000 units, with a modest price correction of 2% from the end of last year. But Property Guru says that the bottom of the property cycle is in sight and could come by the end of the year.
Last year it was about -4.3, this year is going to be about -3.5 or so. So the rate of decline around private prices has also been less. This will be less this year compared to last year. The challenge around private, of course, is that the volume is still very, very low. But a good thing again is that's stabilizing. So as we get towards the end of this year, that rate of price decline and also volumes will start to moderate. So I think we're reaching the end of the bad story in terms of the property market, but we're not there yet.
Property consultants Cushman & Wakefield think otherwise.
I don't think property prices are bottoming out this year, because if you look at the demand drivers, we are not really seeing anything that's boosting the demand for our private homes. If you look at the unemployment rate, it's actually has crept up in the second quarter. We're seeing slightly more companies downsizing, and some people are losing their jobs, especially in the banking sector. You're not going to see a lot of people jumping onto the property bandwagon, especially when the price is sort of moderating, it's not really going up.
Property agency DWG also disagrees and thinks prices will gradually come down till 2016.
Well, I don't feel that the property price is going to be bottom out so soon, for one very good reason, because there's always a steady supply for the next 2 years. Example, like new homes will be completed and people will take over the homes, they have their old houses to be put into the market, and for that the supply is pretty a lot.
This year, 26,000 private new homes are coming on stream, and another 28,000 units will be completed by the end of next year, mainly from the suburbs or outside central region. Due to oversupply, OCR or suburban prices are expected to decline faster than those of the other regions. But prices in the city centre or core central region are expected to hit bottom first.
If you look at some of the rumours that maybe the income thresholds for BTO and also EC, if that's increased, then you start to get quite close to the affordable housing or mass market condos in OCR. And that could therefore start to impact a little bit around the pricing of OCR. And generally, given the supply that's coming on, there's quite a lot of supply coming on. Whereas you look at CCR, what we've seen is that price decline was very, very heavy in 2014, has halved in 2015. So the rate of decline in CCR is the most marked. So in other words, it's not reducing as much as it was before. Whereas the flip side is true for OCR. In other words, it didn't really decline that much last year. It was actually declining a lot faster this year.
And while the government's decentralisation of business centres away from the CBD has increased the popularity of suburban condos, Cushman & Wakefield believes now is not a good time to invest in OCR.
So far, ever since the peak in 2013, it has only come down by like 3% as compared to 8% for the central region. So that said, I don't think people should look at OCR, the mass market segment, with the intention to go into the market again, because if you look at the inventory, there is a lot of inventory in the OCR, and because of the weak demand in leasing, we're not going to see a lot of units being rented out.
Still, there were some successful new launches in the mass market segment in the first half. Overall, property developers are taking the cue, with total new launches reduced to half from the number last year. They are also pricing existing inventories 10 to 15% lower. With property prices falling, buyers are even more price sensitive.
But what they're fully considering is the price that they pick up today, how much more it could actually appreciate, not so much on locations.
And they don't mind playing the waiting game to achieve the purchase amount they desire.
Now the market's moving significantly slower, and what you're seeing is that people are taking more time. So the whole research to purchase process has gone from perhaps 6 months to around about 9 months, according to what we see in terms of inquiries and searches before it becomes a transaction.
The buyer may be thinking of buying a house, but after looking a few rounds, they find that the price may still go down a little bit more. They turn their interest to renting. So even in our places here, we find that the rental volume on our transactions has gone up quite a bit. Why not I rent a place for a short term for 6 months or maybe a year or so. Then from there we see how much more the price will go down.
But DWG believes as property prices moderate moving into 2016, sales volume will pick up.
Because sellers become more realistic about the prices, and all they need to go is just to go down a little bit more in their asking price, and that would be a good entry for the purchaser.